It's Friday, 10th of May, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, Chinese overcapacity. Does it exist, doesn't it? Or are the US and China barking up the wrong tree? And an exclusive clip from our global inflation briefing. But first, Group Chief Economist Neil Shearing is with me again to look into the rearview mirror of the week gone by and down the road at the week ahead. Hi there, Neil.
Hi, David.
Let's start, shall we, with the UK and that Bank of England meeting on Thursday and the GDP data that has just come out, taken together. What does it all mean in terms of where the UK economy is heading and how the bank is going to respond?
Yes, big week for the UK economy. We've had the Q1 GDP data, but also the Bank of England meeting. The meeting itself was notable because we had a second vote for a rate cut from Deputy Governor Dave Ramsden. But I think also the press conference that accompanied the decision, Andrew Bailey refusing to rule out a rate cut at the next meeting in June. Of course, revisions to the bank's forecasts, revising down their inflation profiles, their inflation forecasts. So I think opening the door potentially to a rate cut in June. And then, hot on the heels of the bank's decision, we get Q1 GDP data that showed that the UK economy actually grew faster than expected in Q1. So 0.6% Q-on-Q rise in Q1. And the details pretty strong as well. So particularly consumer spending up and business investment as well up. So strong domestic demand in the UK. So the question really, I guess, is does the strong Q1 GDP data rule out rate cuts in June? I think at the margin, it perhaps makes them a bit less likely, but I don't think it takes them off the table altogether, not least because one has to view the strong Q1 performance in the context of a 0.3% Q-on-Q contraction in Q4. And really, the UK economy has gone nowhere for the past 12, 18 months. So better news in Q1 supports our view that growth this year is going to be a bit stronger than the consensus expects, but I don't think it alters the picture on monetary policy to a substantial extent. And I suspect that on balance, a June rate cut's still in play.
Yeah, it was notable, Bailey saying, I'm optimistic that things are moving in the right direction in terms of inflation, which I suppose is as good as it gets from a central banker at this stage of the cycle. But that does bring us to the US, where things are a bit more up in the air, aren't they? The big release in the coming week is CPI on Wednesday. That's coming a day after the latest PPI data. Is this CPI report going to be another whoopee moment like that last payrolls report, or another uh-oh, as we've had with so many inflation reports of late?
Well, we're forecasting an increase in core CPI of 0.3% month on month in April, which would be somewhere in the middle, I think. It's neither a disaster for markets, but nor do I think it would get the bond markets cheering and starting to price in aggressive rate cuts either. So somewhere in the middle. As ever, the devil will be in the detail. We expect motor vehicle prices to drop back. There's probably going to be a weather-related drop back in clothing prices too. But set against that, we have a wild card in health insurance prices, with the BLS due to incorporate new data based on retained earnings of health insurance that goes into the health insurance component of the CPI basket. The other wild card, of course, is what happens to shelter prices, with the CPI measure of shelter breaking apart from the other data we get on rental agreements. And so does shelter inflation start to fall a bit more substantially in April? That's the other key thing to watch for. I guess the other final point worth making is that gasoline prices were up by about 2% in April. So headline inflation will be up but slightly more than the core inflation. So we've gone for a 0.4% month-on-month increase. So lots of detail there. Keep an eye on the core number, 0.3% month-on-month. That's what really matters. But shelter inflation and health insurance prices, they're the wild cards as well in the detail to keep an eye on.
And if the report does turn out the way you're describing, how is that going to feed into Fed thinking, do you think?
Well, one report on its own is not going to change the Fed's mind on rate cuts. But if it's 0.3% month on month, then I think what it will certainly do is, if there's any doubt that the Fed might be mulling tightening policy, that will now come completely off the table. 1 month's not going to change their mind on rate cuts. But if we're getting movement in the right direction, then I still think it's possible that we get rate cuts in September from the Fed.
Okay, and Obviously, what's happening in the labour market is a big part of this inflation question. We've got a clip coming up from our client briefing held just a couple of days ago about the global inflation picture. And the clip's going to be focusing on what's been happening with labour markets and how that feeds inflation in the US and in Europe. But I would like to move on because we do spend a lot of time talking about what's happening in advanced economy inflation. But what about what's happening in emerging markets? Our colleague Brad Saunders had a report out in recent days looking at easing cycles there. I thought it's a bit of an eye-opener, isn't it? Can you talk about what's been happening with EM inflation and what that means for market expectations around EM rate cuts through the rest of this year?
Yeah, really interesting as to what's happening with emerging market inflation at the moment. Of course, the Central Bank of Indonesia hiking interest rates in response to the strength of the dollar, the weakness of their currency, and some speculation about whether other central banks in the emerging world will follow. Our sense is they probably won't follow in terms of hiking interest rates, not least because Bank Indonesia is unique in having part of its mandate focused on exchange rate stability. But combination of a strong dollar and sticky services inflation means that I think interest rate cuts might be slower to come through than some in the market currently anticipate. And Brad's note, as you say, is well worth a read, but essentially that's making the point that if you wind the clock back 12 months, what was driving inflation in emerging economies was essentially food, energy, and goods inflation. Those three drivers of inflation have now fallen away, and services inflation is coming down, but it's coming down very gradually. So the stickiness of services inflation, I think, is a concern for central banks in the emerging world. We got the similar message from the Central Bank of Mexico, from Banxico, when it met over the past week. And that's partly because of inherent lags in services inflation, but also because of the tightness of labour markets in emerging economies and strong wage growth. So you put all that together, I think what it means is that unlikely that other central banks follow Bank Indonesia's lead in hiking rates in response to a strong dollar. But I don't think that policy is going to be loosened this year to the same extent that the consensus is currently expecting.
You mentioned the impact of a strong dollar on EMs there, which it actually segues nicely to our Spotlight project for this year. Before you go, let's just talk about an aspect of that project. The report launches in early June, and we've just announced details of the London event, and it's all about this idea of US outperformance and whether that will continue. Now, we've got Mark Williams and Leah Fahy from our China team coming up in a moment to talk about Chinese overcapacity. But talk, will you, about the other part of that equation. China is producing loads, it's exporting loads. Who's buying it, and is that process sustainable?
If you're a balance of payments nerd like me, this is the really interesting part, I think. So the counterpart to China's surplus has to be a deficit somewhere else. And in the past, when we've had a large increase, a substantial increase in China's surplus, we've had concerns building about global trade imbalances. And we've seen that similar debate start to play out in markets over the past month or so as China's trade surplus has continued to increase. Now, because of the size of China's economy, there's only really one country that can absorb a surplus on the scale of China's, and that's the US. So last time we saw China's surplus increase substantially, the US deficit also increased. And that was in 2007-8. That was a clear sign, really, that the US economy was living beyond its means, that the current account deficit had exploded. It was about 6% of GDP at one point. Today, the US current account deficit is about 3% of GDP. So the really interesting question is, how is it that the US is absorbing this China surplus, but its current account deficit has not exploded? And the answer is that back in 2006, it was running an energy deficit of about 2% of GDP on its current account. Now the energy deficit has switched to a small surplus because of the expansion of shale oil production, but also natural gas exports. So the switch in the US from being a net energy importer to a small net energy exporter means that it's been able to absorb China's surplus on the manufactured goods side without seeing a substantial deterioration in its current account position. And that's another way in which the US's economic resilience, external resilience, has increased over the past decade or so and has fed into this picture of US economic outperformance. Now, the question is all of this sustainable? Well, on the one hand, the current account deficit of 3% of GDP, that's not in the territory where we would be concerned about large external deficits from a macro imbalances perspective. However, the consequence of the US having run pretty substantial current account deficits for the past 25 years means that it's accumulated a large stock of external liabilities. They're now running at about 70% of GDP. So a key question we're going to get into in the report is, does this legacy of current account deficits over the past 25 years pose a substantial threat to the US economy over the long term, and in particular to the dollar?
Neil Shearing there on the US current account deficit. We'll have a lot more to say about this in our upcoming Spotlight project, which looks at the future of global macro and markets leadership. So it's not just about the US. It explores whether China and the Eurozone will ever catch up, where this bubble in US equities markets is going, and what happens to the macro picture if that bubble bursts, and much more besides. There'll be loads of online and in-person events to mark the project's launch in early June, starting with that London panel discussion that I mentioned on June 11th. I'll put details of that on the podcast page. Would love to see you there to meet up with the team and join the conversation. Watch out for our coverage in the coming week of those US inflation releases, but we'll also be tracking upcoming EM inflation releases as well, including India, Argentina, and Saudi Arabia. I'll pop Brad's note that Neil discussed in the podcast page. If you haven't seen it, take a look. A lot to think about there in terms of the pace of policy easing. And staying on EMs, we've got a drop-in. That's one of our short-form online briefings this coming Thursday, all about what a potential re-election of Donald Trump would mean for these economies, so which stand to gain, which could lose out. Sign up for that on our events page, capitaleconomics.com/events, where you can also watch recordings of past sessions. We run a regular program of these drop-ins. They're around 20 minutes long and designed so you can get your questions answered quickly and get on with your day. And remember, if you're a subscriber to CE Advance, our premium platform, you get access to all of these events, all our analysis, all our data, and much more besides. Find out more about that at capitaleconomics.com/CE-advance. Now, that bit I mentioned about Chinese overcapacity. US officials, including Janet Yellen and Antony Blinken, think Chinese overcapacity is a real problem. But according to Xi Jinping, it simply doesn't exist. And as far as China's foreign ministry is concerned, the US suffers from a quote-unquote overcapacity of anxiety stemming from a lack of confidence and smears against China. So who's right? Everyone and no one, according to Mark Williams, our chief Asia economist. He's taken a close look at Chinese production, sales, and exports of vehicles to draw some stark conclusions about what's happening to China's trade balance. Here he is speaking to Leah Fahy from our China team, and the conversation begins with Mark weighing into this difference of opinion between Beijing and its major trading partners.
So there's these sort of two different readings of what's going on. From the Chinese side, it's about tech leadership from Chinese EV makers. From the Western side, from the US and European side, it's about overinvestment, overcapacity that results from that overinvestment in China. And to be clear, I think both of those things have a lot of truth in them, but it feels to me that there's another part of this story which isn't getting talked about so much, which is the role played by weakness in demand in China. Because, of course, a trade surplus, a net exports, is a net position. It's exports minus imports. So you've got to look at both sides of it. And in particular, when we look at the auto sector, it's a really good illustration of the importance of thinking about not just the production within China, but also the demand for these goods within China. Because you might get the impression from the way that a lot of the reporting about China's export prowess in autos is framed, you'd get the impression that China is suddenly producing a lot more cars than it was a few years ago. And that's certainly the implication of this idea that we're hearing from the European and US governments, that increases in capacity are a big part of the problem. But actually, if you look at how many cars China produced last year, it's kind of getting on for about 30 million cars or vehicles overall. That's just about the same as it produced in 2017. So actual production is no higher now than it was, a few years ago. What has really shifted over the past few years has been demand for cars within China. So we've seen that total vehicle sales in China about 10% down on where they were in 2017. So that's really where this kind of excess supply has opened up. They're not producing any more cars than they were a few years ago, but they're just selling fewer of them domestically. And that's been a big reason why these car producers have been looking to markets outside China to try and sell their stuff. So you can't tell the story of China's sudden emergence as a big EV exporter without talking about the fact that sales within China have been very weak.
Right, so it's a domestic picture as well. And I guess it's not just a story about electric vehicles, is it?
Electric vehicles, I think, is a good kind of way into thinking about this, both because it's in the headlines, a lot of people are worried about it, but it kind of illustrates some of these things. But we are seeing this more broadly. I mean, as you know, you've been looking at some of this, of the Chinese trade data across different product types. Something that we've been talking about for quite some time has been the fact that China's share of global exports in aggregate has been close to all-time highs in the past few months. But maybe you can pull out some of the sort of interesting bits that you found when you're digging into the different parts of China's export basket.
Yes, it's interesting. I guess all the sectors that you'd expect, these ones that are getting talked about a lot, China has seen a big increase in export market share if you compare levels now to pre-pandemic levels. But also it's been a lot more broad-ranging than that. And I think what's most interesting to point out maybe is those sectors that aren't considered as high-tech, perhaps, have also seen quite a significant increase in comparison to 2019. So textiles, for example, we've seen quite a few different subcategories within that see a really large increase in China's export market share at the global scale, which suggests that it's not just a story of China's technological superiority or even the investment that the government put into these higher tech sectors leading up to the pandemic. But it's a more broad-ranging story of the overinvestment since the pandemic, but also the weakness in domestic demand. And I guess on the textile front especially, it's interesting to think that China's competing at a global scale, not just with developed markets in these higher tech sectors, but also with emerging markets that might be seeking to kickstart their growth and drive significant development by increasing their export market share in these lower tech sectors that drove China's growth. But China's still kind of crowding them out in that sense.
Yeah, I mean, when you think about the sort of the ladder that successful export manufacturing emerging economies tend to climb, it typically starts with, textiles and these kinds of things. So if China is now increasing its market share in those areas, that's a very difficult environment for other EMs to start to kind of climb up that ladder. But of course, coming back to my original point here, it's like all of the focus in these kind of discussions tends to be on the export side of the equation. But I think more attention should be given to imports. I mean, one way of thinking about it is that right now China exports goods that are worth sort of 20% of its GDP. I don't think that in itself is a problem. I don't think it would be a problem if it was 25% of its GDP for the rest of the world, as long as China was also importing goods that were worth equivalent amount. The problem, though, is that China's imports of goods are worth about 15% of its GDP. So there's a 5% of GDP gap there. And so one way to close that gap is to do things to, reduce exports. But another way, which would be good for the world, but also good for China, would be to do things that could boost China's imports. If China's consumers were spending more, if they had more income, their quality of life would be higher, they would be consuming more, they would be importing more, that would be good for other economies. And it would reduce, I think, a lot of the tensions between economies. I mean, they wouldn't all go away. The US clearly has other reasons to be that it's concerned about China's rise. But I think a lot of the heat would be taken out of these trade debates if China was importing a lot from the rest of the world. Unfortunately, though, when you listen to what Chinese policymakers are saying about this situation, they seem to see China's trade surplus as an unalloyed positive, as showing that China's doing really well. It's doing, fantastically, competing with the rest of the world. So with that kind of mindset, it just doesn't seem like there's going to be any change.
Yeah, so I guess that kind of begs the question, what do we think is going to happen going forward? I don't think we expect Chinese demand to increase significantly, and if the state's not looking to change, I guess its growth model in that sense, it doesn't look like there's going to be any improvement on China's side. Do we think other countries are going to retaliate with greater tariffs, or what do you expect?
Yeah, I mean, on the Chinese side, I guess we can't completely rule out that there'll be some change, but it does feel like there's no push in that direction for the sort of structural reforms that would boost domestic consumer demand. We've got this third plenum coming up in July where the leadership is promising some reforms, but so far, given what we know, I don't think we should be holding out too much hope. So yeah, as things stand, it does feel that the current situation is not sustainable. You've got a Chinese economy which is directed towards investment and increases in capacity, which go beyond what China is able to consume itself. So it has to depend on exports. But then you've got the rest of the world is pushing back against that. So the other way that this could resolve itself would just be the rest of the world kind of shutting its markets off to China. I think that right now we're seeing elements of that happening, but there doesn't seem to be an appetite at the moment for kind of across-the-board measures that would shut off these markets for Chinese goods. We're seeing, I mean, particularly Europe has been quite interesting recently. There's been a flurry of activity in terms of kind of investigations into Chinese goods and so on. So it definitely does feel like European government, or the EU anyway, is stepping up its efforts to try to protect domestic producers, domestic markets. But so far, while it doesn't seem likely the barriers to trade and investment are going to get higher, there are these other objectives that policymakers have. Actually, access to cheap goods is generally seen as a good thing. China is the dominant supplier of the products that will be needed for the green transition. So because there's these competing objectives, I think that so far it's likely that restrictions that we see on trade are going to be gradual, they're going to be targeted. So we're not going to see the walls go up suddenly, certainly in Europe. So it may well be, that China is able to continue to run a significant trade surplus for some time to come.
That was Mark Williams on why China's trade surplus isn't going anywhere anytime soon. I'll post his analysis on the podcast page. Chinese industrial production, investment and retail sales data for April is out this coming Friday, so watch out for the China team's instant reaction that day and their follow-up analysis. Finally this week, as I also mentioned in my chat with Neil, here's that exclusive clip from the team's recent drop-in on global inflation trends. That online briefing was held to answer client questions about our recent Global Inflation Watch report, which made the case for advanced economy inflation returning more or less to target by year end. In this clip, you'll hear Simon McAdam from our global team talking to Deputy Chief North America Economist Stephen Brown and Senior Global Economist Ariane Curtis. And it begins with Ariane on the outlook for services inflation in advanced economies.
So we do expect service inflation to ease over the coming year. That's mostly because we think that demand will weaken in advanced economies. So we are forecasting a couple quarters of slightly below potential GDP growth in advanced economies. Demand's already actually been fairly weak in Europe, and while it's been much stronger in the US, we expect some of this resilience to fade. And what we've actually already seen is that kind of the weaker demand, or at least this better balance between demand and supply, has already reduced firms' pricing power, for example. So the contribution to inflation from corporate profits has fallen already, even in the US, and we would expect that to continue. In terms of policy, that's generally not going to be as supportive to inflation falling significantly in the year ahead. Even though we do expect rates to be cut later this year, the upshot is that, advanced economies are still yet to probably feel the full impact of the previous policy tightening. And interest rates are still going to remain quite high, which will be a constraint on new lending and also make refinancing more expensive. So really the main factor that will help reduce services inflation is this weaker demand outlook.
Okay, so a weaker demand outlook to soften services inflation, but I mean, labour markets are key too to all of this. And if we just think to the US in particular, I mean, we've had a weaker set of payrolls in the latest reading, but we have had a strong run of payrolls numbers come out of the United States. And if we looked at the unit labour cost numbers out of the US in Q1, they were also pretty punchy. So, I mean, did labour markets pose an upside risk to all of this? Let's start with you, Stephen, from the US angle.
Yeah, I mean, I think on the surface, the US labour market certainly still looks quite strong. I would say our sense is that it's kind of easing underneath the surface, so by a lot more than some of the headline measures might suggest. So, for instance, even within that recent employment growth, about 50% of net jobs growth over the last 6 months is from just two sectors, healthcare and state and local government. Those are not really signs of cyclical strength in hiring demand, but they're obviously propping up the headline employment numbers. And then we look at other measures such as the job vacancy rate has been coming down. The job quits rate in particular is now much lower than before the pandemic. And that's the measure that has tended historically to have the closest relationship with wage growth. So our sense is that wage growth is going to fall over the rest of this year. There have been mixed messages in the recent data. So, for instance, as you said, Q1, the employment cost index rose by a bit more than we anticipated, and coupled with weak productivity growth, unit labour cost growth did rise pretty strongly in the first quarter. I guess the caveat is that is quite a volatile measure, unit labour cost growth. So in annual terms, growth actually slowed because Q1 in 2023 was even stronger. So it was actually only 1.8% in annual terms, which is not something anyone would be concerned about in terms of the inflationary impact. And then moving into Q2, for instance, the April payroll survey shows that average hourly earnings only rose by a fairly soft 0.2% month on month. So consistent with the idea that we should see a softer employment cost index growth rate this quarter. So, our sense is that the pressure is coming out of the labour market, particularly in terms of what it means for wage growth. And so we should see those measures fall over the rest of this year. So I don't think we'd be too concerned about the recent strength of some of these more idiosyncratic services price moves, rather than focus on where wage growth is going and see that as a sign that services inflation will continue to slow this year.
Okay, fine. So if we look under the surface, the US labour market is actually cooling and coming into better balance, consistent with weaker wage cost pressures. Of course, in the US, you have actually seen quite a moderation of wage growth over the past year, as it in terms of where we've got to already. That's in contrast to Europe and other advanced economies, isn't it, Ariane? So there are some differences here in the contrast between labour cost pressures in the US and other advanced economies. How much of that is a problem in terms of trying to get services inflation down in the year ahead?
Yeah, so I would agree. I would say that tight labor markets and kind of the stickiness in wage growth is really one of the key upside risks to inflation in advanced economies. As it stands in Europe, in the UK and Eurozone, the combination of weak productivity and high wage growth means that unit labor costs are still much too high to be consistent with central banks reaching their 2% inflation targets. But generally, there is still evidence that labor markets are cooling. So we've seen the job vacancy rates gradually coming down, surveys of hiring intentions and labor shortages easing. And we have seen wage growth at least fall from their peaks, albeit not to the extent that it has in the US. But we think that the wage growth really should ease further as some of this weak demand takes the heat out of labor markets, and that it should contribute to lower services price pressures going ahead. So in that sense, similar to the US.
Stephen Brown and Ariane Curtis there talking to Simon McAdam about the inflation outlook. Watch the whole recording on our events page, but I'll also add it to the podcast notes. I'll also add that Global Inflation Watch report. It's out 4 times a year and gives you a unique holistic view of how price pressures are evolving across DMs and EMs. Well worth checking out. But that's it for this week. We'll be back next week with more on the global macro and market story, including a post-mortem of that US CPI release. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.